Good morning, guys. Please give me a quick confirmation. Is the audio video all clear? Shall we begin? Yes, is the audio video all clear? All right. So let's begin. Now, in this video, in today's session, we are going to discuss the other mock test paper, the April 2021 paper. So basically, ICAI has brought out two mock test papers. You would be obviously aware of it. The first one is a March 2021 paper, which we've already done in yesterday's session, right? And in today's session, I'm taking up the April 2021 paper. All right. So let's begin. We'll start with the MCQ questions first. All right. And then we will go to the descriptive questions. Same way like we did in the yesterday's session for the March 2021 paper. All right. Now, in this mock test paper, I would say that the kind of questions asked are not very, very difficult. Mock test paper 1, the March 2021 mock test paper had a lot of good questions, a lot of challenging questions. But the second mock test paper is more or less on the easier side. Some MCQ questions may be, good ones, but the rest of the paper seems to be pretty straightforward. So let's begin, starting with the first MCQ. Let's read the question. It says Mr. Alishan is engaged in the business of clothes trading since 2015. His minor daughter's marriage is fixed in December 2020. He planned a destination wedding in Udaipur for his minor daughter. For the wedding, he withdrew 40 lakh rupees cash in the month of August 2020 and 65 lakh rupees cash in the month of September 2020 from Aapka Paisa Bank. He booked 30 rooms for 5 days for the accommodation of his relatives in Raho Hotel and paid rupees 40,000 in cash as advance and balance by account pay check. He took catering services of Dana Caterers, a sole proprietor, for the wedding, for which he paid 10,20,000 on 15th October 2020. For her wedding, he gifted his daughter a house property purchased from RK Builders on 10th October 2020 by account pay check for rupees 15 lakhs. Stamp duty value of the property on 10th October 2020 is rupees 16 lakhs. And on the date of transfer to minor daughter, it is rupees 20 lakhs. All right. Then Mr. Alishan paid rupees 45,000 in cash and the balance in check to travel agent for the return ticket of some of his relatives to US. He has not filed his return of income from previous year 17-18. His daughter let out the house property received from him at a monthly rent of rupees 40,000 from 1st November 2020. Based on the above information, choose the most appropriate option of the following MCQs. First of all, the first question over here. Before we go to the question, let us discuss the story, what exactly has happened over here. So in this story, my assessee, Mr. Alishan, is getting his minor daughter married. For that, number one, he's withdrawing cash. Number two, he's paying for accommodation of guests at a hotel. Number three, he's paying for catering services. Number four, he's gifting a house property to his daughter as a marriage gift. And then he's also making payment towards travel of his relatives. All right. And the house which the assessee gifted to his daughter, that house the daughter has later given on rent of 40,000. This is what the question says. Now going ahead, look at the MCQs. The amount of tax to be deducted by Aapka Paisa Bank on cash withdrawals by Mr. Ali Shan will be what? They're asking us about the TDS on cash withdrawals. Now here, I'm sure you would be remembering section 194N. Try recalling section 194N. Question number 1, we are doing subdivision 1. What does section 194N say? Section 194N says two things. It talks about two scenarios. Scenario number 1, in all 3 preceding previous years, if you did not file the income tax return as per section 139 subsection 1, if you did not file for all the 3 preceding previous years, then if you withdraw cash from a bank up to 20 lakh of cash withdrawal, no TDS. If the cash withdrawal is more than 20 lakh up to 1 crore, then 2% tax will be deducted at source. If you're going to withdraw more than 1 crore on the excess, 5% tax will be deducted at source. But in case scenario 1 is not applicable, which means you did file your income tax return in 3 preceding previous years, scenario 1 will apply only in 3 preceding previous years if you did not file your income tax return on time. But if that does not happen, which means if you do file your income tax return in the 3 preceding previous years, then on the withdrawal exceeding 1 crore, only on that tax will be deducted at source and at 5%. This is how the concept goes. Okay, now if you look at this question, what has happened? It is very clearly given that he has not filed his return of income from previous year 17-18. See, in this question, we're talking about previous year 2021. If I talk about 3 preceding previous years, I'm talking about 19-20, I'm talking about 18-19 and 17-18. The question says 17-18 onwards, he has not even filed his income tax return, which means 3 preceding previous years, he did not file income tax return, and therefore we'll have to apply scenario number 1. What is the total cash withdrawal? Totally, he has withdrawn 40 lakhs and 65 lakhs. He has withdrawn 40 lakhs and 65 lakhs. So totally, he has withdrawn 1 crore 5 lakhs. So we will have to apply scenario number 1. Right. Now, as per scenario number 1, up to 20 lakhs, absolutely no TDS. For the withdrawal between 20 lakh to 1 crore, that is on this 80 lakh, we will have TDS at the rate of 2%. So what is 80 lakh into 2%? 1,60,000, right? This will be your TDS under 194N for this withdrawal of 20 lakh to 1 crore. Then beyond 1 crore, how much did you withdraw? 5 lakhs. On this 5 lakh, we will ask you to deduct tax at 5%. So here 25,000 will be deducted. All right. So the banker is going to deduct 1,60,000 tax at source for the withdrawal of this 80 lakh. What is this 80 lakh? Between 20 lakh to 1 crore. And on the withdrawal in excess of 1 crore, that is the excess of 1 crore is 5 lakh. On this 5 lakh, the bank will deduct tax at source at the rate of 5%. All right. So what will be the total tax deducted at source? 1,85,000. Is this clear for everybody? Yes. So now if I look at the solution, if I look at the options, here our answer will be option D. I hope you all understood this. This is a straightforward application of section 194N. Absolutely no complication. It is very clearly given my assessee did not file income tax return for the last 3 years. Therefore, we'll have to apply the amended provision. This part that we discussed over here, this is the amended provision, amended by Finance Act 2020. All right. What does it say? It says up to 20 lakh, if you're going to withdraw, no tax deducted at source. Beyond 20 lakh up to 1 crore, 2%. Beyond 1 crore, 5%. So the total tax to be deducted at source would be 1,60,000 on this 80 lakh and 25,000 on this 5 lakhs, total 1,85,000. All right. So this is it with question number 1. Then number 2, amount of tax to be deducted by Mr. Ali Shan on payment made to Dana caterers. See, when you make a payment for catering, it does come under section 194C. Section 194C of your Income Tax Act talks about tax to be deducted at source relating to works contract. And if you look at the definition of works contract, it does include catering. But in this question, what do you think? Should we deduct tax under 194C? Definitely not. Not required. Why not? Because 194C TDS not applicable when I make payment for personal purposes. Right? Now here, the payment which we are making to the caterer is not related to the business or profession of the assessee. The payment which is made to the caterer is because of his daughter's wedding. So which means here the payment is for a personal purpose. Whenever you make payment for personal purposes under 194C, TDS is not required to be deducted. You understand? Yes, the see in 194C, we talk about single transaction more than 30,000, aggregate transactions more than 1 lakh, 1% TDS, 2% TDS. All that is not applicable if it is for personal purposes. Yes, catering is works contract under 194C, but this catering service is being taken for a personal purpose. Hence, no need to deduct tax under section 194C. Are we clear? This is it about the second subdivision. Now talking about the third subdivision. For which of the following transactions Mr. Alishan is required to quote his PAN? See, quoting the PAN number is not required for every transaction. Now, whenever you make payment, there are only few transactions where you have to quote your PAN. For example, if you make a payment to a hotel or to a restaurant more than 50,000 in cash, you will have to give your PAN number also to the hotel. If you make a payment to a travel agent more than 50,000 in cash, even here you will have to give your PAN number to the hotel. If you make payment for an immovable property more than 10 lakhs in cash, then again we have to disclose our PAN number. But here in this question, if you see, the immovable property, RK Builders, it was purchased for 15 lakh rupees. See, immovable property, when you're purchasing, it doesn't matter what is the mode. Any immovable property you purchase, the full value consideration of which or the SDV of which is more than 10 lakh, no matter what mode you're making the payment in, if you're purchasing a property, all right, and if the value of the property is more than 10 lakh, you have to quote your PAN. Now, my assessee, Mr. Alishan, has purchased a building. He has purchased a house property from RK Builders for 15 lakh rupees. The value of the property is certainly more than 10 lakh. Because it is more than 10 lakh, here PAN has to be quoted. See, payment is made by account pay check. For immovable property, how did you make the payment doesn't matter. So even though I did not make the payment by cash, I still have to quote my PAN number for this immovable property. Why? Because I spent more than 10 lakh for it. I spent 15 lakh. So here definitely we have to quote the PAN. Now payment to the hotel. How much did we pay to the hotel? We paid only 40,000 in cash. When do we have to quote PAN relating to hotels and restaurants? Only if we pay more than 50,000 in cash. But here we have paid only 40,000 in cash, hence it is not required to quote the PAN number. Then when I talk about payment to travel agent, here we have paid only 45,000 in cash to the travel agent. When we make payments to travel agent, PAN has to be quoted only if we pay more than 50,000 in cash. But here we are paying only 45,000 in cash. So for payment to Raho Hotel and payment to travel agent, here for these two transactions, no, we do not have to quote our PAN. We do not have to quote our PAN. All right. But for purchase of immovable property, we do have to quote our PAN. Why? Because whenever we acquire a property for more than 10 lakh rupees, no matter what is the mode in which we are making the payment, if it crosses 10 lakh rupees, we have to quote our PAN. For hotel and agent, not required because we are making a cash payment, but not more than 50,000. Hence, it is not required. So here our answer is going to be option A. All right. This is for subdivision 3. Now coming to subdivision 4. what shall be the amount taxable and in whose hands with respect to purchase of immovable property by Mr. Alishan from RK Builders and gift of the same to his daughter. So here they're talking about this transaction wherein Mr. Alishan has purchased a house property from RK Builders and then he's gifting it to his daughter. So there are two transactions that we are discussing about over here. We are discussing subdivision 3, by the way. There are two transactions. Number one, RK Builders is selling a house property to Mr. Alishan. And for this house property, how much is he paying? It is purchased for rupees 15 lakhs. SDV on 10th October 2020, 16 lakhs. On the date of transfer to minor daughter is 20 lakhs. So Alishan is paying rupees 15 lakhs for this property and they have also given stamp duty value. Then Mr. Alishan is gifting this property to his minor daughter on the occasion of his marriage. Okay, now what are they asking us in the question? What shall be the amount taxable and in whose hands with respect to purchase of immovable property by Mr. Alishan from RK Builders and gift of the same to his daughter? Now, if you look from the perspective of Mr. Alishan, he has obtained a property. He has obtained an immovable property by paying rupees 15 lakhs. Just look at this transaction first, okay? Look from Mr. Alishan's perspective. So Mr. Alishan has paid 15 lakh for a house property. And what is the stamp duty value of this property? When he acquired, on the date of acquiring, stamp duty value was 16 lakhs. Okay, now when we talk about SDV of an immovable property, now here, don't you think Mr. Alishan has acquired an immovable property for consideration, for inadequate consideration, right? Property worth 16 lakhs he has acquired by paying just 15 lakhs. But then in this case, obviously IFOS section 56(2)(10) we apply. But whenever you acquire immovable property for inadequate consideration, it will be taxable for you only if your SDV is more than 110% of FEC. Let me not confuse you too much. Whenever you acquire an immovable property for inadequate consideration, from Mr. Alishan's perspective, he has acquired property worth 16 lakh by paying just 15 lakhs. So here, how to compute his tax liability? We follow a set of steps, right? What is his SDV? SDV is 16 lakhs. And what is the FEC? How much is he paying for it? He's paying 15 lakhs. What is the difference? Difference is 5 lakhs. Then we see what is the standard. The standard is 50,000 and we calculate 10% of FEC. 10% of FEC is, no, the difference is not 5 lakh, difference is 1 lakh. 10% of FEC is 1,50,000. Then standard or 10% of FEC, whichever is higher, 1,50,000. Now this difference of 1 lakh, this will be taxable only if it is more than 1,50,000. 1 lakh is not more than 1,50,000. So for Mr. Alishan, it is not taxable. Did you understand? Each one of you may have different methods of computing the taxable income in case the assessee acquires an immovable property for inadequate consideration. Generally, in our sessions, we do these 6 steps, right? What are the 6 steps? We see the SDV, we see the FEC, and we find the difference. The difference is 1 lakh. Is this difference going to be taxed or not? Depends upon whether the difference is more than this number or not. What is this number? This number is the higher of standard of 50,000 or 10% of FEC. So 1 lakh is not more than 1,50,000. Hence, nothing at all will be taxable. So for Mr. Alishan, nothing is taxable. And if you look from the daughter's perspective, daughter has received a gift from her father, and that too on the occasion of marriage. So definitely, even for the daughter, the gift is going to be exempt. So there will be no tax implications for Mr. Alishan and for his daughter. All right, now let us see which of the answers would be correct. They say 1 lakh taxable in the hands of Mr. Alishan. No, we just said nothing is taxable for Mr. Alishan. then nothing is taxable in the hands of Mr. Ali Shan, RK Builders, and minor daughter. Does seem to be correct. Let's look at the other two options also. 1 lakh in the hands of Mr. Ali Shan? No. Nothing is taxable in the hands of Ali Shan and RK Builders, but 20 lakhs is taxable in the hands of minor daughter. We just discussed nothing will be taxed in the hands of minor daughter because she is getting a gift from her father, and that too on the occasion of her marriage. So the correct answer will be option B. Nothing is taxable in the hands of Mr. Ali Shan, RK Builders, and minor daughter. Now you might be wondering, why didn't we talk anything at all about RK Builders? When I did the entire discussion with you, I spoke to you only from the perspective of Mr. Ali Shan and minor daughter. What about the perspective of RK Builders? Now, RK Builders, at what price did they acquire? All that is not even given to us in the question. What is RK Builders' cost of acquisition? What is their cost price? Is it their stock in trade? Is it their capital gains? Nothing is given to us. We don't need that information. Even without the information, we were able to spot the correct answer. Are we all clear with this subdivision as well? Yes. So until now, if you see, the first subdivision was all about section 194N. The second subdivision was section 194C, but we said 194C tax no need to be deducted because the assessee has made the payment for personal purposes. Subdivision 3 could be something which you may not be aware of in case you haven't learned, because a lot of students generally skip this part. Remember, PAN has to be quoted if you acquire any immovable property for more than 10 lakhs. All right. And then in subdivision 4 was simple. From Mr. Ali Shan's perspective, nothing was taxable. Yes, he did acquire an immovable property for inadequate consideration. The inadequacy was 1 lakh, but this will not be taxable because it is not more than 1 lakh 50. From the minor daughter's perspective, if you see, she has received a gift from her father, and gifts from relatives are always exempt. All right. So this is it about my subdivision 4. Now coming to subdivision 5. What shall be the amount taxable under IFHP with respect to let out of house property by daughter of Mr. Ali Shan, and in whose hands will it be taxable? Do you remember we discussed that the house which Ali Shan is giving to his daughter, what is the daughter doing with this house? She is giving this house on rent. She is letting out this house on rent. Okay. Now, whatever rental income is earned from this house, it will be taxed in whose hands? That is subdivision 5 all about. Okay. Now, listen to me. Whenever an assessee transfers his house property to his spouse or to his minor child, and in return, if they give the assessee either nothing at all, or if they give the assessee inadequate consideration, then the assessee will be the deemed owner. This is a concept which you would have studied in IFHP, right? When the assessee transfers a house property to his spouse or to his minor child for no consideration or for inadequate consideration, the transferor assessee will be deemed to be the owner. All right. So this is a concept that you would have studied. But this deemed ownership concept does not apply if the asset is transferred to spouse under an agreement to live apart. Then you don't apply this concept of deemed owner. Also, if this minor child happens to be a minor married daughter, okay, then also we don't apply this deemed owner concept. Now, in this question, the assessee is giving the gift of the house property without any consideration to his minor married daughter. Right? So that is why we will not apply the concept of deemed owner. So we are excluding deemed ownership concept. But then when we talk about clubbing provisions say that when assessee's minor child earns any income, and if that income is not because of the minor child's skill, talent, If that income is not because of minor child's manual work or labor, and if the minor child is not disabled, then the minor child's income has to be clubbed in the hands of the parent who's earning higher income. Right. So here, if you see in this question, I cannot apply the deemed ownership concept. Yes, my assessee is giving a house property to his minor child, but the minor child happens to be a minor married daughter. Hence, we cannot apply the deemed ownership concept. That is why we will come to the clubbing provisions. Under clubbing provisions, when a minor child earns income, that income will be clubbed in the hands of the parent. So here, my minor child, the minor married daughter, is earning rental income. What is a rental income? 40,000 per month. His daughter let out the house property received from him at a monthly rent of 40,000 from 1st November 2020. Now here, so we'll have to compute IFHP, right? Because rental income. So if you compute IFHP from let out house, we start with the gross annual value. Now for gross annual value, you need the municipal value, fair rent and all that is not given to us. So we will straight away take the actual rent number. The actual rent is 40,000 per month. So 40,000 per month for how many months will we consider? November, December, Jan, Feb, March. Only for 5 months. So 40,000 into 5, what do we get? 2 lakh. Yes. From this we subtract municipal taxes paid, which is nothing. Then from this we subtract our deductions under section 24. First of all, we deduct standard deduction at the rate of 30%, which will be 60,000. Then interest on borrowed capital not given to us in the question. So 1,40,000 is going to be our IFHP. We compute the taxable income in the hands of the minor child and then we club it in the hands of the assessee. So the minor child's income of 1,40,000 will be clubbed into the assessee's hand. But whenever a minor child's income is clubbed with the assessee's income, the assessee gets an exemption. Do you remember the exemption? Do you remember the section number of the exemption? Yes, are you following? Whenever minor child's income is clubbed with the parent's hands, the parent gets an exemption. What is the exemption that the parent gets? The parent gets an exemption of 1,500 per child, isn't it? Which section? Section 10, clause 32. All right. So the minor child's income is 1,40,000. This 1,40,000 will be clubbed with the parent's income. The parent will get a 1,500 exemption. So 1,40,000 minus 1,500, 1,38,500 will be taxed in the hands of the father, Mr. Alisha. Are we all clear with this? Yes. So first we tried applying deemed ownership concept, but that was not applicable because a minor child happened to be a minor married daughter. That is why we applied clubbing provision. We first computation of IFHP is very simple over here, no adjustment at all. IFHP was 1,40,000. This 1,40,000 will be clubbed in the hands of Mr. Alishan. So end of the day, who is going to pay tax? The father, Mr. Alishan. 1,38,500 taxable in the hands of Mr. Alishan. How 1,38,500? 1,40,000 is IFHP. From this, we will give 1032 exemption of 1,500 and the balance will be taxable. Are we all clear with this? Okay, let's proceed to the next subdivision. So this is it with question number 1. We'll go to question number 2 now. Question number 2 is a very, very interesting question. Let's read it. It says, Pankaj gifted an amount of rupees 3 lakh to his wife Pinky and 2 lakh to his daughter Rinky, aged 20 years, on 1st April 2017. Both Pinky and Rinky invested the amounts on the same date in Government of India 11% taxable bonds. Interest accrues yearly and is reinvested in the same bonds. Determine what will be the amount taxable in the hands of Pinky for assessment year 21-22. Is the question clear for everybody? Yes. See what has happened in this question. I'm talking about question number 2 now. Here, my assessee, Mr. Pankaj, his wife, Pinky, and his daughter, Rinky. So, Mr. Pankaj gifts 3 lakh rupees to his wife, and Pankaj also gifts rupees 3 lakh to Rinky. Okay, not 3 lakh, 2 lakh to Rinky. So Pankaj gifts 3 lakh to Pinky and 2 lakh to his daughter. Both of them invested the amount on the same date in 11% taxable bonds. All right. So let's talk, and they're asking us just about what will be the amount taxable in the hands of Pinky alone. They are asking us. In Pinky's hands, what will be the taxable income? When did Pankaj give this money? He gave this money on 1st April 2017. Okay. And what did Pinky and Rinky do with this money? They invested this money into government bonds, 11% government bonds. So we can forget about Rinky for the time being. Why? Because Rinky over here in this question, they're not asking us her tax liability. They're just asking us what will be the amount taxable in the hands of Pinky. So our entire discussion will be only from Pinky's perspective. All right. Now here, listen to me. On 1st April 2017, Pankaj gave 3 lakh rupees to Pinky. So on 3 lakh rupees, in the previous year, 17-18, so end of the year, on 31st March 2018, Pinky would have earned interest of 11%. 33,000 interest Pinky would have earned, right? This becomes income from transferred asset. Clubbing provisions will apply over here. Pankaj has transferred an asset to his spouse. We're just talking about this transaction, Pankaj to Pinky. Pankaj has transferred an asset to his spouse for no consideration, inadequate consideration. Any income from this asset in the same form or different form will be clubbed in the hands of Pankaj. So Pankaj gave cash. This cash has changed form into bonds. So income from these bonds will be clubbed in the hands of Pankaj. So 33,000 she would have earned on 31st March 2018, which would be clubbed in the hands of Pankaj. Now, what are they saying? The question says that the interest income is reinvested. So now, on 31st March 2019, Pinky will earn 2 interests. She will earn interest on this 3 lakh at the rate of 11%, even on 33,000, which she earned in the last year. Even on that, she will earn 11%. Why? Because this 33,000 income, she did not withdraw. This 33,000 also she put into the same bonds. All right. So even on this, she's going to earn interest. So what will be the interest over here? 33,000 is what she will earn from these 3 lakhs. And from this 33,000, how much is she going to earn? From 33,000, she's going to earn 3,630. So her total income will be what? 36,630. Even this income, she's not going to withdraw. She's going to reinvest. So on 31st March 2020, again, she's going to earn 2 interests. On her original 3 lakh rupees, she's going to earn 11% interest. Then on this 33,000, which she had reinvested, on this 33,000 also she will receive 11% interest. Even on this 36,630, which she received last year, even that she would have reinvested. Even on this, she will earn 11% interest. Do you agree with me? Yes. So she is going to get interest not only on 3 lakh, even this 33,000 has gone into the bonds along with 3 lakh. Even this 36,630 has gone into the bonds along with 3 lakhs. So what will be her total interest? On 3 lakh, she will be earning 33,000. On 33,000, she will be earning 3,630. And on this 36,330, she will be earning 4,029. So what is the total interest which she has earned now? She has earned 40,659. Even this, what will happen? Even this will be invested in the bonds. All right, they're asking us to compute Pinky's income for assessment year 21-22. Assessment year 21-22 means previous year 2021. So one more year. What about 31st March 2021? On 31st March 2021, she is going to receive 4 interests. On the original 3 lakh, she is going to receive 11% interest, 33,000. Then the first 33,000 which she had invested, even that is still in the bonds. From here also she will get interest, 3,630. Then this 36,630, even this she had reinvested in the bonds. Even on this she will get 11% interest, that is 4,029. Even this 40,659 she has invested into in the same bonds, last year's interest. Even on this she will get more interest. She is going to get 4,472. So what is the total interest that she has earned? Her total interest will be 45,131. 45,131. This is what her total interest will be. Now out of this interest, 33,000 will be taxed in the hands of Mr. Pankaj. Why? Because Mr. Pankaj gave cash to Pinky for no consideration or for inadequate consideration. So the transferred asset was cash. This cash changed form into bonds. Any income which is earned from bonds, so from the 3 lakh rupees bonds, from this bond, whatever money she earns, that will be taxed in the hands of Pankaj. And the money which is earned from the interest, this 36304029, all these numbers, if you see these 3 numbers, they are nothing but income from income, isn't it? These incomes are nothing but incomes from reinvesting the interest. So income from transferred asset alone will be clubbed. Transferred asset is 3 lakh. From 3 lakh income is 33,000. This alone will be clubbed. What is the balance income? The balance 3 income comes to 12,131. This alone will be taxed in the hands of Pinky. Right? Income from transferred asset is to be clubbed. 33,000 will be clubbed with Pankaj's income. Income from income. This 12,131 is income from income. It is income from the reinvested interest. That shall not be clubbed. So on 12,131, Pinky herself will pay tax. So what is the correct answer? What will be taxable in the hands of Pinky? 12,132. Right? I'll give you a minute. In case anybody is still writing, please finish this and then we will proceed. I hope we are done writing. This was a very good question. Shall we proceed? Oh God, there's a power cut. Anyways, let's go on. At least one more question I think we will be able to work out. The third question. Mr. Mango, an Indian citizen, lives in New York, USA since the last 10 years. He has a penthouse in Mumbai given on rent at the rate at 2 lakh rupees per month. During the year 2021, he came to India for 152 days in aggregate. His total stay in India in the 4 preceding previous years is 366 days. You are, being the tax consultant of Mr. Mango, advise him about his residential status for assessment year 21-22. Now, individual, we have to find his residential status. We always talk about the special provision first. Regular provision, special provision, all this we've already discussed in the March 2021 MTP also. So we'll always try applying the special provision first. To apply special provision, we have to fulfill some conditions. Number 1, assessee should be an Indian citizen. Number 2, he must be engaged in a business or a profession outside India. Number 3, he must be coming on a visit to India in the previous year. And number 4, his total income minus his income from foreign sources should be more than 15 lakh. Now let us see if all these conditions are fulfilled even in this question by Mr. Mango. Yes, he is an Indian citizen. We don't know. They say he lives in New York. If he lives in New York, obviously he would be having some business or profession outside India. Yes, he is visiting in India for 152 days in the previous year. When we say total income minus income from foreign sources, basically we are talking about his Indian income. Indian income with source in India should be more than 15 lakh. He is earning rental income from Mumbai. So he is having Indian income, Indian source income, 2 lakh rupees per month. 2 lakh rupees per month, if you see, it's definitely going to be more than 15 lakh, isn't it? 2 lakh into 12, 2 lakh into 12 minus 30% standard deduction if you do, you get 16 lakh 80,000. His IFHP from India, from Indian house is 16 lakh 80. So his total income minus income from foreign sources is definitely more than 15 lakh. All right. So all these conditions are fulfilled. Hence, what will we apply? The special provision. What does the special provision say? Basic condition 1 is same. Assessee should have stayed in India in the previous year for 182 days. But here in this question, he is staying in India in the previous year only for 152 days. Basic condition 1 not fulfilled. What is basic condition 2? Special provision basic condition 2 is that in the previous year, he must stay in India for at least 120 days, and for preceding previous years, he must stay in India for 365 days at least. Here, if you see, both the conditions, both the parts of the second basic condition are fulfilled. In the previous year, he is living in India for more than 120 days. He is living in India for 152 days. And for preceding previous years, if you see, he is living in India for 366 days, which is more than 365 days. So basic condition 2 fulfilled. Hence, we will say assessee is resident. Okay. Now, once we conclude the assessee is resident, we will also see whether he is an ROR or whether he is an RNOR. Right? Now, when do you say he is an ROR? If special provision is applicable, when do you say he is ROR? Number 1, first basic condition should be fulfilled. Number 2, we have 2 additional conditions. That is, he must be a resident in at least 2 out of 10 preceding previous years. And number 3, he should have stayed in India in the 7 preceding previous years for at least 730 days. But if the first basic condition is not fulfilled, then we straight away conclude assessee is RNOR. Here, the first basic condition is not fulfilled. So we needn't even look at the 2 additional conditions. We can straight away conclude assessee is RNOR. Are we clear? Yes. When we talk about here, why did we apply special provision? Because assessee was an Indian citizen. He was engaged in business or profession outside India. He was visiting India in the previous year, and his income from Indian sources is more than 15 lakh. Therefore, we applied the special provision. Under the special provision, the first basic condition did not get fulfilled. Hence, we tried applying the second basic condition. Second basic condition says, in the previous year, assessee should have stayed in India for 120 days, which was certainly fulfilled. Also, it says for preceding previous years, assessee should have stayed in India for at least 365 days, and even that was fulfilled. Hence, because basic condition 2 was fulfilled, we concluded that our assessee is a resident. He's a resident, but he's a resident as per special provision. All right. He's a resident as per special provision, and first basic condition is not fulfilled. Hence, we will conclude he is RNOR. Shortcut. This is a shortcut. If special provision is applicable, and if you conclude assessee is a resident, when you're checking whether he is ordinarily resident or not ordinarily resident, even before you apply the additional conditions, see if the first basic condition is fulfilled. If first basic condition is not even fulfilled, you don't even have to apply the additional conditions. You can straight away conclude RNOR. So your answer will be RNOR. Got it? Yeah. So this is it about question number 3. Okay. Now let's go to question number 4. Another good question. This question is about section 40 subsection B of your Income Tax Act, which talks about remuneration which we pay to our partners. Let's see what the question says. Mr. C, aged 35 years, is a working partner in Messrs BCD, a partnership firm with equal profit sharing ratio. During the previous year 2021, the firm has paid remuneration to Mr. B, C and D, being the working partners of the firm, of rupees 2 lakh each. The firm has paid interest on capital of 1,20,000 in toto to all the 3 partners, and the same is within the prescribed limit of 12%. The firm had a loss of rupees 1,12,000 after debiting remuneration and interest on capital. Remuneration and interest on capital is authorized by the partnership deed. So here, Messrs BCD, a partnership firm, has 3 partners, and it has given each of the 3 partners, each of the 3 working partners, remuneration of 2 lakh rupees. And they've also given interest on capital to the 3 partners, 12% interest on capital they've given to the 3 partners at the rate of 12%, totally 1,20,000. And after subtracting all expenses, even after debiting, even after subtracting remuneration and interest on capital, the firm has a loss of 1,12,000. What are they asking us? You being the chartered accountant of Mr. C is one of the partners of the firm, are in the process of computing his total income. What would be his taxable remuneration from the firm? We are supposed to find out what will be Mr. C's taxable remuneration from the firm. Now listen to me. How to do the calculation? We are going to discuss about question number 4 now. We are solving question number 4. We will first talk from the firm's perspective. Okay, what does section 40B say? Section 40B says, first of all, find your book profit. What is book profit? Your usual PGBP just before remuneration to partners. Ignore remuneration to partners. See what is your PGBP, that is book profit. If this book profit is within 3 lakhs, up to 3 lakh of the book profit, you will calculate 2 things. Number 1, rupees 1,50,000, and number 2, 90% of book profit. And out of these 2 numbers, you will pick whichever is higher. On the book profit beyond 3 lakh, you will straight away take 60% of book profit. This much remuneration will be allowed for the partnership firm. If the partnership firm pays more than this much remuneration, excess will be disallowed for the partnership firm. See, for the partnership firm, remuneration paid to partners is an expense, isn't it? So that remuneration up to these limits will be allowed. Beyond that, excess will be disallowed. This is what we have learned under section 40B from the firm's perspective, isn't it? Now listen to me. What is the book profit in this question? Here they say my firm has incurred a loss of 1,12,000, but this is after subtracting remuneration and interest on capital. Interest on capital is fine. But remuneration you shouldn't have subtracted. How much remuneration did we pay to each partner? 2 lakh each partner, total 3 partners. So 6 lakh remuneration we would have subtracted. We'll reverse the remuneration by adding it back. So what is your book profit going to be now? Your book profit is going to be 4,88,000, right? So we had a loss of 1,12,000. This was after subtracting remuneration, after subtracting interest. But we need to find book profit, which is after interest, but before remuneration. That is why we added back the remuneration. So our book profit is 4,88,000. Okay. Out of this 4,88,000 up to 3 lakh. On the first 3 lakh, we will calculate two things, 1,50,000 or 90% of 3 lakh. 90% of 3 lakh will be 2,70,000. Out of these two, we will pick whichever is higher, obviously 2,70,000. On the excess, what is the excess? 1,88,000. On the excess 1,88,000, we will calculate 60% of book profit. And how much is that? 1,12,800. So what is the total remuneration which is allowed for the firm? 3,82,800. All right. This much remuneration will be allowed for the firm. My firm has paid how much? It has paid 6 lakh remuneration. Out of 6 lakh remuneration, we will allow only 3,82,800. How did we get this? On the first 3 lakh, we calculated 90%, which is 2,70,000. On the excess above 3 lakh, on 1,88,000, we calculated 60%, which is 1,12,800. So total allowed remuneration will be 3,82,800. All right, 3,82,800 for 3 partners. Now let us talk about our 3 partners, Mr. B, Mr. C, and Mr. D. How much remuneration did my firm give the partners? My firm gave the 3 partners 2 lakh each. But how much will be allowed for the partnership firm? This is an expense for the partnership firm. So for the partnership firm, how much remuneration will be allowed? Only 3,82,800. So if I divide by 3, for each partner's remuneration, only 1,27,600 will be allowed for the partnership firm. So what will be disallowed for the partnership firm? The balance. What is the balance? The balance 72,400 will be disallowed for each of the 3 partner salary in the hands of the firm. So these numbers are disallowed for the firm, which means my partnership firm is paying tax on these numbers 72,400, right? Now, what will be taxable for the partner? Whatever is allowed for the partnership firm, this is what will be taxed for the partner. That is how you calculate. All right. Whatever is disallowed for the firm, it is disallowed for the firm, which means the firm itself is going to pay tax on that. So on that same 72,400, I will not ask my partner to again pay tax. In this question, they're asking us what will be taxable income for Mr. C. What will be the taxable remuneration for Mr. C? He is receiving 2 lakhs. But out of this 2 lakhs, on 72,400, the partnership firm itself is paying tax because it is disallowed. So on the same amount, I will not ask the partner also to pay tax. What is the balance? The balance 1,27,600. Only on this, I will ask the partner to pay tax. This will be the taxable remuneration for my partner. Did you all understand this? This is a tricky question once again. All right. So he is receiving 2 lakh remuneration. 72,400 is disallowed in the partnership firm's hand. So on that, we will not ask the partner to pay tax again. But on the balance 1,27,600, we will ask the partner to pay tax. So what will be the taxable income of my partner, Mr. C now? 1,27,600. Are you all clear with this? Simple, right? Shall we proceed? So this is it with question number 4. We calculated book profit. We computed how much remuneration is allowed in the firm's hand. We saw what was disallowed in the firm's hand. Whatever was disallowed in the firm's hand, on that amount, we will not ask the partner to pay tax again. All right, we'll close question number 4. Let's come to question number 5 now. 5 and 6 simple questions. Question number 5. Listed Internationals Inc., a non-resident, engaged in the business of selling good Z, appoints Mr. Risky as an agent in India for selling such product. Mr. Risky works as an agent for several other persons, also including non-residents, aiding them in selling their products. The appointment of Mr. Risky, is it going to be a business connection, yes or no? Will Mr. Risky's appointment be considered as business connection? See, it will be considered as business connection only if Mr. Risky is going to work just for listed internationals and not for others. But here Mr. Risky is working for many other persons also. So which means Mr. Risky is an independent agent. Who is an independent agent? An independent agent would be one who is working for several persons. Independent agent will not be considered as business connection. All right, this is something which you would have studied in the first few chapters, where you would have learnt about incomes deemed to accrue or arise in India. So when a person has a business connection in India, and through that business connection, if the person earns income, it will be deemed to accrue or arise in India. Business connection does not include an independent agent. An independent agent is a person who is representing, who is doing work for several people. Mr. Risky is working as an agent for several people. So he becomes an independent agent. So he is not a business connection. We cannot call him a business connection. So he is an independent agent and it will not lead to business connection in India. Your answer will be option D. All right. So this is about question number 5. Now coming to the last MCQ. Mr. Krishna, a resident Indian, aged 61 years, resident individual 60 and above. He becomes a senior citizen. He maintains a saving account with a cooperative land development bank. He earns 20,000 interest from this cooperative bank, interest on saving account, for the financial year 2021. Mr. Krishna also maintains an FD and recurring deposit account with Money Finance, which is a non-banking finance company, and earns 25,000, 10,000 interest on FD and recurring deposit respectively. What would be the deduction allowable to Mr. Krishna under Chapter 6A if he does not opt for Section 115 BAC for the assessment year 2021? They're asking us what will be his Chapter 6A deduction. They're talking about interest and all. So which section comes to your mind, guys? Section 80 TTA, Section 80 TTB. But then because he's a senior citizen, resident senior citizen, we will apply Section 80 TTB. Section 80 TTB gives a maximum deduction of 50,000. It covers interest on savings bank account. It covers even FD interest. But FD should be with a bank. FD cannot be with an NBFC. See here, there are totally 3 things which he is earning. 20,000 savings bank account interest from a cooperative bank. This will be allowed under 80 TTB. But he earns 25,000 and 10,000 interest from NBFC. Interest income from NBFC does not come to Section 80 TTB. We consider cooperative banks, we consider scheduled banks, we also consider interest from post office accounts. but NBFC interests are not allowed under 80TTB. So the only deduction we will get under 80TTB will be 20,000, and that 20,000 is well within the limit of 50,000, hence it will be fully allowed. Understood? That is it with question number 6. All clear, right? So with this, we are done with all the MCQs of the April 2021 mock test paper. I hope all of you are clear. The questions were not very complicated. We did have some good questions like the 40B question. Then remember this question we worked out, interest on interest, income on income. This Pankaj and Pinky question. These two questions are good ones. The rest of them are pretty straightforward, which I'm sure you would have been able to do even otherwise. All right. So this session I will close over here. We will meet again maybe after another hour. Around 3 o'clock, we'll meet again and we will work out the descriptive questions. Okay. So we will meet again in roughly an hour. All right. Around 3. And in the next session, we may go on for 2 to 2.5 hours and we'll finish off all the descriptive questions. All right. So that is it for this session. I hope you guys are benefiting out of these discussions. A lot of concepts, a lot of sections get revised through these questions. So we'll close over here. We'll meet again at 3. Thank you guys.